Hi, real estate investor friends. Hey, this is Kenn Renner, real estate expert in the North Austin area, Liberty Hill to be exactly, up in the Northwest Tech Corridor. And wow, we've had quite a run over the last several years here in Austin, and it's been quite an adventure. Since 2020, I've closed over $100 million in transactions and over 500 million over my career. I've been in the business now for 40 years. And I just want to talk to you about some opportunities that we've been finding for our clients that have been very profitable and actually very lucrative. We've actually found properties that are back to pre-pandemic pricing, pre-pandemic interest rates, and and the cash flow is pre-pandemic as well. So just to give you a little bit of an idea of what we're going to be doing, we're going to be talking about the mega region in the Austin San Antonio corridor. The two cities are going to combine, they're going to merge here, and the region's exploding right now in activity, both in construction and people still moving here by droves. So just without further ado, I want to go ahead and get into my notes here. Okay, so our presentation today is how to invest in turnkey properties in Central Texas emerging mega region. And we're talking about the two largest cities, two of the four largest cities in Texas, Austin and San Antonio, that are merging. They're only about 50 miles apart right now. But they're coming together like Dallas Metroplex, Dallas-Fort Worth Metroplex. Austin, San Antonio is becoming one of those Metroplexes. And so we've been having great opportunities finding amazing deals, wholesale deals with major builders in this target area as low as under $200,000 for brand new construction. So the golden window of opportunity here is, I'm just going to go cut to the chase, and then we'll get into all the details, a lot of information following this, but this is why I'm presenting this presentation here, is the builder's opportunity to sell homes at basically wholesale costs or substantially discounted over current pricing. So certain builders will be financing their properties at by year end. They really want to make their year end and their quarter ends numbers look really good for Wall Street. As you know, the national builders are all on the stock market, and they need to get their numbers up. And so as we get into the quarter and the end of the fiscal year end, they start slashing these prices, offering incentives, offering appliance packages, and amazing interest rates and all this other stuff. So we're going to go into complete detail on that. Plus, we're going to cover a lot of information regarding the market, where we're seeing this head in 2024. And really, we're going to see an astounding amount of sales coming up, as we have a huge amount of pent-up demand and we still have a shortage. One of the biggest factors here is the NFC builder financing. NFC stands for National Forward Commitment Financing. The builders have found a way, they had to continue selling their product at interest rates. They went to Wall Street and bought, and to Fannie Mae, Freddie Mac, and bought blocks of money, hundreds of millions of dollars, where they can offer interest rates as low as 5.75, 5.5, 6% for investors as well as owner occupants. So this is a game changer for not only for our investors, but also for the home buyers right now. They're getting interest rates that were back, like I said, pre-pandemic. So we'll get back into this golden window, but I want to give you, this is the gist of it. We're buying properties at basically wholesale prices, and we're getting it at well below market interest rates. Right now, interest rates on 30-year fixed for investors is close to almost 8%. So to get under 6% into the mid fives is an amazing opportunity. And our clients are enjoying it. Even my assistant here, Andrea, she just bought a house right around $200,000 and got 5.75% interest rate. All right, a little bit about me, and then we'll get on to why you came to this presentation. I've been 40 years in real estate. I'm turning 60 this year. I got my first license in Anchorage, Alaska when I was 20 years old, 19 years old, actually. And I've been in real estate ever since. I've been in Austin, moved here, got married in 1993. So 30 years ago, 30 years of marriage. So it's great to be watching this city grow. And then over $500 million in closed sales, of which $100 million of that came in the last, since 2020. So I'm recognized as one of the top investment brokers in Central Texas. I'm a best-selling author, an international speaker, been on House Hunters several times. And we support the Hope Cause, which is housing opportunities possible for everybody, where we also fund into both local and international home affordable housing opportunities. So that's enough about me. I'd love to connect with you. And that's what this is all about. It's about relationships. We'll be talking about in a little minute about how we build relationships and how I can help you build a portfolio of properties of cash flow properties, appreciating assets that are not tied to the stock market, and to help recession-proof your opportunities moving forward, to shelter you from the ups and downs of the other equity type markets. So hard assets is where a lot of people, and especially the millennials, I love working with millennials buying their properties here because they're just so excited that they're getting a hard asset. This is what we're talking about. Central Texas super region. It's been called a metroplex. It's been called a megaplex. It's basically taking the two cities, Austin being the 10th largest city in the nation, high-tech government and education is the hub of the activity there for employment. And then San Antonio is tourism and military and manufacturing industry. San Antonio is the 7th largest city in the nation. It's actually bigger than Austin. It's about close to 2.5 million people. Austin's just over 2 million people. So in this region, we have about 4.5 million people. Well, I guess, almost 5 million people in this area. And the expected, they just came out with the expectations for this area, these two cities. It's going to grow by another 3 million people in population by 2050. So they've got to put the folks somewhere, and they've got to live in housing somewhere. And that's what we're here as investors, is fulfill that need of providing housing for tenants and to have them help us pay our mortgages off. So if you notice down here, by 2045, 53% of the population between San Antonio and Austin expected to live just within 5 miles of this corridor. So we focus on not only Austin. Austin's gotten overpriced, and it's even with the reduction of prices gone down over 10-15% since its peak. It's still, we're looking at a median price of $550,000, $570,000, which is good compared to a lot of areas in the nation, especially tech areas. But it doesn't do well for cash flow and to make the numbers work. We actually, I've sold hundreds and hundreds of homes in Austin. It's a great place to live. But investment-wise, around 2021, we really slowed down and actually stopped buying investment properties in Austin because, first of all, there was a feeding frenzy. 1,000 properties got sold at 2,200 homes got sold at over $100,000 over asking price. It was nuts. 96 offers on one house, 152 offers. We were just not going to compete with that. Plus, people were getting frothy about their investing, and we just don't want to throw money. The numbers still got to make sense, the dynamics. So San Antonio, though, is about 50% of the value of a median price home in Austin. We'll get into those numbers here later on. But the bottom line is that our rent's about 80% of the Austin rent, but our values are the purchase prices are 50%. So this area is where we've been focusing on, and we've had a great pleasure of helping a lot of our clients acquire properties in this megaplex region. So, we're going to go over some of the Austinites hightailing it to San Antonio because Austin is not nearly as affordable. You can go 55 miles, 70 miles south or in between and buy houses that are substantially less and great quality of life. And so that's actually 20% of the people moving to San Antonio are moving from Austin. Okay, so Elon, he talked about Austin and the areas around here as being the biggest boom that America's ever seen for the next 50 years. So yeah, arguably one of the smartest guys on the planet. And he's also an investor in real estate, though it's not obviously his core business. He does own 6,000 acres of Texas, and about half of that is in the Austin area, including where he has his gigafactory, which has about 2,200 acres just in that area alone. He's also acquired property in Bastrop, Texas, just southeast of Austin, about 20 miles from his gigafactory, to do his Starlink and his boring company and things like that. So these are some of the areas that we focus on because the guy's arguably super smart, and he's bullish, and he's buying up a lot of Texas land. So he's actually building homes for his employees. That's pretty interesting that they're actually building homes for the employees because housing shortage. We still have a housing shortage, big time. There's his big building, amazing, and actually the Cybertruck should just started to come out of that building. Like them, love them, leave them. But the fact is Tesla is cranking along, super cranking right now. So. The high tech Google downtown, Oracle across the river downtown, the domain having 10 miles north of downtown with Amazon, Facebook, and Verbo. Apple, just another 10 minutes north of the domain, has its $1.2 billion facility. You also have the biggest facility right now being built is the $17 billion Samsung chip plant, which is about 10 miles, about 15 miles northeast of Austin in the town of Taylor. And so that $17 billion plant is worth more than all those other tech buildings I just showed you combined. So Samsung's doubling down, and I believe that they're planning on building another factory here. So also now taking a look at San Antonio. What does San Antonio got? H-E-B, the largest grocery store chain in Texas and the 7th largest in the nation. We have one that just got built down the street here. So they're amazing stores. And they're really very efficient, and they've got great. People love their H-E-Bs here. So their a company is stationed out of San Antonio, and it is the 7th largest grocery store chain in the nation. So I think it was 135,000 employees. It's huge. Toyota has a huge manufacturing. They build their Toyota trucks, the Tundra trucks, down in south of San Antonio. USAA, just north of downtown, is one of the largest insurance companies in the nation. And there we have a military Air Force base. Randolph Air Force Base is where the pilots get trained to join the Air Force to get in those planes. And so, I always tell people worried about Air Force bases closing, not these Air Force bases, because they're training facilities. And I don't think the world's got much safer, and we need our jets and we need our pilots trained. There's also Lackland Air Force Base and a couple other bases that are nice anchors to the rental market here in San Antonio. Of course, tourism's a big deal. The Alamo, the Riverwalk downtown. This is actually where we go vacation, because it's only, even from North Austin, it's only about an hour and a half down to get to really just a lot of fun golf and water sports and resorts. It's really, really cool. And the Riverwalk downtown is iconic. And then, of course, the kids love to go to SeaWorld and Six Flags, Texas, and that's always fun to get out there and to rock and roll on the roller coasters. Of course, we got our San Antonio Spurs, and they've got the AT&T Center just north of downtown San Antonio. So yeah, it's a big city. It comes with all the other things a big city carries, as far as jobs and opportunities, and 2.5 million residents. They've got quite an economy down there. All right, this is a great PBS special that it's just Google this one, the San Antonio Austin emerging mega metro. If you're watching on YouTube, probably have a link to this down in the comments. But it's a great video. It's two of the former mayors, Cisneros and forget our Austin mayor, but the former mayor. They are talking about what's happening between these two cities, and that's where we're talking about investing in. Okay, so back to the mega region. When we're looking at investing, San Antonio, being a big city, has all kinds of opportunities to invest. There's areas I really wouldn't invest in, and there's areas that I think are fantastic. And that's what we narrow it down for you. And so right now we have the west side of San Antonio is where better schools are, better infrastructure. Actually, San Antonio has amazing infrastructure. Their roads system are much more laid out better than Austin's road system. And there's near the Air Force bases. There's also down south near the Toyota plant. These are areas that we have on our list of properties to look at. We also like New Braunfels a lot. That's a city between Austin and San Antonio. Love that place. Go there as soon, anytime I can, is get down to New Braunfels, Seguin. Those are the two towns that are right here. But the little 10 is where Seguin is, right off the 130 toll road and the Highway 10, which goes across the nation. And then 35 is where New Braunfels are. It's a resort town right on I-35, absolutely exploding with growth. San Marcos, just north of that, Texas State University. That's the home at Texas State, the fifth largest college in university in Texas. All right, so kind of what we've been looking at, and the reason we started looking down San Antonio. We started also looking north of Austin and we sold several hundred homes in the Central Texas region near Killeen, Temple, Belton, about 50 miles north of Austin. And then we are started to look down south because of the housing affordability. If you notice down here, the median price home, cost home in San Antonio right now is $254,600. Most every house that we're selling right now is actually under that, and they're brand new construction. Austin's almost is more than double that at $577,000 for the same house, same builder, $577,000, double the price. So people are taking the flight to affordability. We also have the median in the United States is $338,000, which is interesting because that's substantially higher, $70,000 or more than San Antonio. So being the seventh largest city in the nation and being under the median by far, and both United States and Austin, Texas, makes it very attractive. It's also much more affordable in a lot of the other costs of living, health costs, housing costs, energy costs, all that's a lot cheaper in San Antonio. All right, so this is a cool chart that kind of fits in with why we as investors are very excited about buying properties here. We actually have a very huge shortage of homes nationwide. So just to kind of make my point here, I'm going to stop the share. So according to the National Association of Realtors, across the nation, we're somewhere between 4 million and 6 million housing units short for the current population growth that's planned. We are actually, when the Great Recession hit, builders pulled way back and they haven't caught up in the construction since then. We also have a deadlock. We have a stalemate when it comes to people putting their homes on the market. We're seeing very low inventory hitting the market because why? Everybody has a low interest rate. About 80% of the people have some interest rate under 4.5%. My house here that I'm in is 2.75%. If I was to sell this house and go move down the street, I'd be paying 7.5 or 7.25 right now, unless I go with a builder NFC program. So that's where I get my interest rates back down, and that's kind of what we're looking at. The bottom line is for resale homes, they're just not hitting the market. Sellers are on hold because they've got a great interest rate, and if they move, they're going to have to pay a lot higher for the same product. The buyers are hesitant right now. But springtime 2024, just as 2023 hit, I predict that to be rather active as the feds take put the brakes on the rate increases, making national news, can put people in a more comfortable position of maybe this is time to move forward. We also have the millennials hitting the market, largest home buying largest home buying crowd in the nation that's ever hit. The population of the millennials is going to certainly change things. They're getting of building a family age, right? They don't want to live in apartments anymore. They don't want to live in necessarily downtown urban area. So that feeds into our investment philosophy that if we can buy homes at substantially less than what people could buy them for, they're going to go with affordability. So I'm going to show you this, go back to my screen here. This is a chart that just came out. And it's really cool to see this. I've always been an advocate for home ownership. I've been teaching home buyer classes for 20, 30 years. I've written books on home buying. I just believe in home ownership, but also believe in affordability. And sometimes it's, if you're in transition and you're not going to live there in a particular area for very long, a lot of people moving into town, they don't know where they want to live yet. They're going to rent first and then decide where they want to buy. But if you take a look at this chart, the red line is a very consistent cost to rent. That's one of the things I like about real estate and rents. You can pretty much plan on them going up over time. And this chart's very clear. This is a national chart, and you can see nice, consistent, 5-7% rent increases per year, bringing our total cost to rent right now $1,845 to rent a home. And that's very much in line with the homes that we're seeing in the San Antonio area and the areas in between, about that $1,845 rent. Think about that. Just keep that in your mind. If you're a consumer, I could pay $1,845 rent for that 1,600 square foot, 4-bedroom, 2-bath with one of Kenn's investors. Or if I wanted to buy the home in the same neighborhood, the cost to buy, which is the blue line, is $2,697 dollars per month, nearly $1,000 a month more for owning that same home as opposed to renting. That hasn't always been the case. If you realize, if you take a look at the chart, most of the time as you're going through the 70s and 80s, it was still more expensive to buy a home than it was to rent. But then we had a little bit of a flip-flop around the recessionary period. It was actually higher cost to rent than it was to own after the housing bubble. And for years, I mean, for almost 10 years, it was still cheaper to own than it was to rent. And then we hit pandemic time and mega appreciation, and now we're at $2,700 per month for the same house that you can rent from us for $1,845. So just a matter of affordability, no down payment for our homes. Of course, you got your rent, you got your deposits, but you don't have to pay, 10, 20% down. A lot of people don't have it, and they're going to rent actually to save money so they can eventually buy a home. Put that a little bit closer when I zoom in. You can take a look at over the past, since 2006 housing bubble, where you've seen a dramatic drop in the cost of housing, and then all of a sudden a huge increase. And that's what we're dealing with. So as we're buying homes right now in our brand new neighborhoods and paying 5.95% interest rate, and we're renting them out, they're running about somewhere between $200 and $300 a month positive cash flow. And a brand new construction, fully warranted house. It's really exciting. So I'm going to go back to a little history lesson, because I study history because we have to, because history has a tendency to repeat itself, and it also generates patterns. And so I've taught this by my rich dad and my poor dad. And I have a rich dad, poor dad story. That's my true story, my real dad and my father-in-law, that I talk about in other podcasts and webinars. But that's worth taking a look at, because it gives inspiration into building legacy through real estate. All right, so taking a look at actually mortgage rates are affected by obviously when the recessions hit, the Fed increases the rates to knock down the inflation. Now, back in the 1982, the interest rates started climbing, but then we entered a recession in late 1981, early 1982. So the Feds increased the interest rates to slow down the economy. It did cause recession, and then immediately the interest rates dropped. And we've seen that in a smaller form here in the last go around. Then we also see the rates dropped down around 10%. I actually got into business right here in 1983, right about when the rates were just getting down to 11%. So I've been through a lot of booms and busts in 4 different states and 4 different decades. So interest rates consistently dropped over the next 10 years. And then we had a little bit of a recession between 91, 92, right there. That was actually when the dot-com bomb hit us here in Austin, when the dot-com bust. And so we had a short recession there, but you notice that the interest rates continued to drop. So recessions actually helped get our interest rates down. Then we had all the way down to 2002. Actually, yeah, no, that's the dot-com was 2002. That's right. 1990 was more of the aerospace industry was kind of on edge. Back in 2002, we had after the dot-com bust. Rates are down, they're getting down under 7%. We were buying investment properties, no problem. 6.5%, 7% made sense. Rents were good. Prices were great. And then we got all the way through into the Great Recession in 2008, 2009, 2010. We had seen the biggest drop, longer recession, and actually very, there's a very nasty time, as everybody knows. And if your realtor, a real estate expert, hadn't been through these kinds of booms and busts, they really don't know how to work with the situation with how do you market a home when people aren't buying, or interest rates are too high, or whatever it is. It takes a lot more effort, a lot more marketing effort, a lot more expertise. So choose your choose your professional wisely when you're going into this, if you need to sell your house. Then we had that short recession right when the pandemic hit, and then drove the interest rates even farther down to almost negligible, nothing, down to 2.5% interest rate, which was way too low, and they kept it down for way too long, and that caused the knee-jerk reaction that we saw over the last 6-8 months of increasing those interest rates to slow down this economy, and they've done a pretty good job of it, especially in housing. Where housing is 17% of the GDP, and so we've seen because housing gets hit, it's very affected by interest rates. We've seen it slow the economy down as it was geared to do, designed to do. Take a look at this chart too, is that housing stays strong through recessions. You can look back through the same recessionary periods of just real estate just continued to go up. And the only time it went down for a recession was when the housing industry the mortgage industry caused the bust. So, but that hasn't, in the last 50 years, as you notice, it's only been during that one housing caused super recession that we've seen real estate not prosper during recession. So keep that in mind when you're in your planning. When you take a look at the stock market, recessions are not good for the stock market, especially we're coming towards retirement years. Be careful about where you're investing. I'm not a stock guide, nor do I give stock advice, but I do know, following the history, is that when prices when the recessions hit, it's not good for the stocks. Rents chug just right along. You can see the red line is Austin doing well. That looks about $2,500 a month is where it's ended up here on our rental amounts. It's a little soft right now in Austin on rents. San Antonio, obviously the little brother as far as property values and rent values, has gone up to like about $1,800 a month. So not too far down from where Austin is, but it's a lot more affordable. So that's why you're seeing people take advantage of that. Okay, so this chart here I've been presenting for years, and it's basically the counter cycles of the coast to Texas. So if you look at the red line, that's pretty much Texas ups and downs, and it's more stable, except for our last boom time during the pandemic. It's more stable towards it, but we're actually like looking about 85. The California market was just coming out into from a recession into a boom time period caused by, I believe, aerospace, and that's when I actually moved back there in '86 and rode this wave up here and did a lot of refinancing, working in the mortgage industry, and so I cut my teeth on mortgages, so I know the financing really well. In the meantime, Texas had just come out of a commercial real estate crunch. And they ended up having a recession down in 1990. So while it was booming in California, it was recessionary in Texas. So Texas from 1990 through 2000 just climbed very, very systematically, very steadily. And then, of course, in 91, 92, the California market had a correction, and it didn't bottom out until 1997. They actually had about 30-40% correction. You'll find also that the California market is much more volatile. It goes up faster and further, and comes down further and faster. So fast forward to 05, 06, coming into the great boom here. We had Austin was doing quite well, kind of following along with what was going on in the California market, and then all of a sudden, the mortgage market just collapsed, and so and once again the California market dropped 30%. Actually, Texas prices didn't drop much at all. The median price stayed pretty much the same through that Great Recession. That's why it's kind of flat here. It just flattened out. Volume went way down. That's kind of where we're at now. Volume is substantially down in Austin. But then coming through 2010 all the way to 2020, we kind of had steady, slow growth in Austin. And then you had huge growth in pricing in California. And that's when I started going back to California doing presentation. I started in the early 2000s, sold hundreds of homes to Californians back then. And then starting around 2017, I started revisiting and I've sold, like I said, 400 homes in the last since 2020. And so really helped our clients. And so I don't have the chart going forward on the rest of this, but I can tell you pretty much that we are now in a mini counter cycle because the past 3 years we've had Austin prices going up 100% in value, and then we had California kind of teetering as people were leaving in droves, and so it started dropping in value. So we had that, Texas boom, and the California started to drop a little bit during that pandemic period. But then supply was so short that recently, I'm talking to my California brokers out there, and they said that the market's so not enough supply. So they're seeing, once again, back to bidding wars. They're seeing just not enough supply of homes in the market. And so that's driving prices back up. Counterintuitive to what you would think would happen in this day and age, but they certainly are. And Texas, especially for the Austin area, it's kind of just flat, right? It's not, and it's already done its drop. It's not really dropping anymore. It's still very affordable, all things considered. So a little bit of history, study the cycles. Okay, back to Elon. So Elon has gotten into the real estate game, and that's exciting to see, since he's not really a real estate guy, but he's very bullish on it right now, especially with Texas. Now, Warren Buffett, who's never really been really bullish on housing, he just invested $850 billion in the largest builder in the United States, D.R. Horton. So he invested $850 billion in their stock. These guys are smart guys. And so if they're investing in housing, because we know there's a shortage and they haven't built enough, supply and demand just states that these guys are going to do really well. All the big builders and even the small builders as they move through, if they have the NFC financing. All right, so we're back to the golden window of opportunity. With that all being said, a little economics history lesson. So fiscal year end builder closeouts. That's what we focus on. Super big discounts. They're not worried about profit. They're worried about volume. And we help fill that and for the benefit of doing that, we get a substantial discount, anywhere from 12 to 20% below the market value. We've been closing homes in the San Antonio, Austin corridor as low as 200,000, 210,000, 215,000. And each builder has a different fiscal year end, and they have a different fiscal quarter end. So got to know these things, and that's why you have me, because I've been hearing for forever, for 30 years. So I know all the builders, and they know me. And then getting that low interest rate, that's huge. And so taking a look, basically the builders had to come up with a solution, which is the NFC financing. This is an article from Forbes talking about one of our national builders at 4.25. This is actually a really cool article about how the mortgage buy downs that the builders are doing behind the scenes cost up anywhere from 8 to 10 points, 8 to 10% to be able to buy those interest rates down into the fives. So that's tens of thousands of dollars, which really effectively lowers the price of the house, because they're financing up front the price. So if you're paying $220 for a house and they had to pay 10 points, they're actually only making $200,000 on the house because of the financing. All right. So the part why I bring that up again is because of my relationships with the builder. I want to build a relationship with you if we don't already have one. And that's what I'm all about. But I also build relationships with the people that have the control of the inventory. And so this is what I call the good old boy factor. It took me years to learn about being a good old boy. That's a Texas term for somebody who's been around for a while, can be trusted. Somebody that you can, you're not worried about, getting your back stabbed or anything like that. That's a good old boy. He's going to do the right thing, and he's well connected. So it took me years to earn that right to be a good old boy. Also gave me opportunity because of the volume that I do to connect directly with C-level executives of these building communities. I have insider knowledge, which is legal in real estate, and I have some influence and been around for long enough and respected in the industry. So we get actually lists daily. We used to get them every week or every few weeks of what's available. We get lists daily of their wholesale inventory. So I get the homes a lot of times before they ever even hit the market. A lot of times an on-site agent, who's our source, will have a property come back on the market because the first-time home buyer didn't qualify. They'll call me up and say, hey, we've got to sell this home. Really good deal. Offered just at this price only for next couple of days. Do you have somebody? I always usually have somebody in my back pocket that's looking. And that's why a lot of these properties will never hit the market. And the other thing you don't want to do, if you haven't been involved, some of these builders have 30, 40 subdivisions across a city, and you don't know which ones have the NFC money. You don't know which ones allow or don't allow investors, because a lot of them don't allow investors. You don't necessarily know from a distance where the best areas are where everything lines up: good schools, good infrastructure, good quality of life, good jobs, all that kind of stuff. These are really, really important for us when we're investing. So if you call an 800 number from a builder, you're going to get an internet, somebody probably in their 20s that doesn't really know the product. They're not boots on the ground in a particular community. And you can't even get the phone number of the on-site agent usually, or even an email. So the only way you can do it is make an appointment. And you may make an appointment, and it may not even be somebody who actually is working in that community. It just could be some random other builder agent that they pulled in from the other side of town. So you want to work with the people that we're well connected with, because first of all, they know what they're doing, they know what we do, how we do it, and they answer their phone as soon as we call. Why? Because we sell 100 homes a year, and they know that there's a potential paycheck on the other side of that phone. So they pick up my calls. So our job is to how we help people invest in real estate is we do all the research, kind of what I just described and more, and finding the right people to be involved with, the networks of help, and go to that in a second. And then we help you with the acquisition, which is finding the right property, picking the right property, and then picking the right financing, getting the financing lined up for you, if you're not in Texas, do all your walkthroughs for you, everything in your stead as if you were here. Say about 75% of my clients don't ever come and see their homes. In pandemic time, we sold more than 95% sight unseen. People just did it. We did it through video, and we did it through FaceTime, and that's how we were able to sell so many homes. And we help with the management. We own our own management company, but we also have two others because we have so many properties that are we don't have enough capacity in our little management company to handle. Plus the distances, we service an area that's 150 miles radius around Austin. So we have vetted and well experienced property managers that handle our areas. They have to have our clients' best interest in mind. I'm giving these managers sometimes anywhere from 10 to 20 homes a month to manage. That's a big portfolio every month that they get. And they got to keep my clients happy. They got to keep our tenants happy, and they got to keep me happy, because if they're not doing their job, we'll take that business elsewhere. So, but because we own our own management company, we know exactly what to do. But what we do differently than most brokers, we help the management company market these homes for lease. Because number one concern that I get in all my surveys when I'm doing my presentations live is I don't want a vacancy. And vacancy is part of the game. You have to have, it's going to be vacant. But what we do is we want to make sure that vacancies are mitigated. In other words, we just did a 2,500 piece mailer to apartment complexes, because we put 6 houses on the ground in San Antonio area, all in the same neighborhood. We found the apartment complexes where they're, and we did a mass mailer to them. We've got open house and for rent signs pointing to our community. We have people, agents sitting on site every weekend to open houses for rentals. I don't know of any other real estate company that has open houses for rentals. But you know why we do it? It works. We're getting our properties leased, and we're excited about it. But you have to be there. We have to be on. We have to be available on site. Make it really easy to show. Honestly, it's hard to find good management. We found it, and we also augment through our budget in getting these places leased, because that's what the number one concern is. And then disposition. Sometime later on, when you want to sell the property, we can help you through save taxes or eliminate taxes or defer taxes through a 1031 exchange. A lot of our clients will, like myself, will buy a property, hold it for 10 years, sell it, take the proceeds, and then exchange it into three or four other properties. So our job is basically a turnkey operation from start to finish. Where we like to be is in kind of the middle of the market. And this chart's pretty cool because it shows the different price points that you could be buying. Obviously, luxury on the far end, not really where we focus on for investor properties. On the low end, we don't focus on that too. We're talking about homes that are run down, fixer flippers. Cash flow is great, but the hassle factor is huge. The appreciation is low over time, and liquidity is much harder, especially if you need to sell during a recession. And cash flow can be a little bit deceiving too, because people will look at their cash flow on a home that's built 30 or 40 years ago and say that's really good. But you have to take into consideration capital expenditures. We sold a couple of properties we bought that were built in the 50s recently, because although they were cash cows, give me $1,000 a month, I had to replace the sewer. It cost me $19,000. So cash flow $1,000 a month, $19,000 in sewer. It took 19 months of my profit out. I just went back to buying new houses so that I don't have the hassle factor. Nor do I have the time to deal with the houses. So great deals kind of in that between the median and between the lower price housing, and that's kind of where we have the sweet spot. Cash flow is good, appreciation is good, liquidity is also very good, and the hassle factor is low. So this is what I help you put together. It's our network of help. So you're the millionaire, multimillionaire real estate investor. We help build portfolios, large portfolios of cash flow and appreciating properties to create financial freedom and also legacy. So I'm a mentor and a consultant to you, and sometimes I become a partner. Well, it's actually become a partner when you go through this process, because we partner together to get this job done. But your inner circle, you need to have these people, and I'd like to be one of those that you would choose as your mentor or your consultant. Support circle, which is really driven by property managers for the most part, actually, we need all these accountants, investors, real estate agents, lenders, attorneys. But for the service circle, we're pretty much looking at the property managers handle this: plumbers, roofers, concrete companies, all this stuff. All the people in the support circle, you're not going to have to worry about dealing with, because the manager will handle it all. But if you need an attorney to drop papers, to do a deed, to do a 1031 exchange, we've got it. We've got the accommodators. Lenders, work with the lenders, especially the builder's lender, to get you the best interest rates. Other real estate agents send me great deals. Other investors are great sources of knowledge and wisdom and networking. And got accountants, CPAs if you need that, and of course contractors. So we're back to our super region, and wanted to kind of show you what the numbers look like. So here's a typical real estate pro forma that we this is just recently, less than a month ago. This was the numbers that we were looking at. House is 218,990, 1,627 square foot, 4-bedroom, 2-bath, 2-car garage, brand new. 2.29 tax rate. Most tax rates we're looking at are between 1.6 and 2.4. So 2.29 tax rate. And so you're looking about we put 30% down on this pro forma, which would be about 65,000 plus your closing costs. You're looking about 70K to get into it. Or if you were looking at your cap rate or your cash on cash return, you're looking almost 6%. It's hard to find 6 caps anywhere, especially in new construction, anywhere in the United States. So take note here that the cap rates here, and especially you're not going to have any really negligible amount of capital expenditures, like having to replace things and doing that, because it's all brand new. Of course, you also have the 5.75% interest rate, which is now in some places 5.5. Plus, they also pay a couple points in closing costs. So the builder pays not only closing costs, but they also got this incredible interest rate, and they're giving you at wholesale prices. That's the sweet spot. That's the opportunity. That's why we're so excited. That's why our clients are excited. So I took this performance. We could do performance on all of our properties. I just took the chunks here and broke it down into the 4 quadrants here. You have your numbers here: 1,627 square foot built this year, 422, 2.29 tax rate, 469. 4694 in annual taxes. Insurance about 500. Insurance is low on new construction, so people question that. I thought it'd be more like 1,200. No, new construction, that's between 500 and 600. Put in 5,000 in closing costs, because even though the builder is paying costs, it doesn't cover it all. Your HOA yearly can range anywhere from $300 to $700-800 a month, or a year, not a month, per year. So you're looking about 30 to $50 a month. When I do an annualized what the leasing fee expenses plus management fee expenses Maintenance is very low on new construction, and then a vacancy factor. And we plug those numbers into to get the cap rate. So here's your cap rate. We used your the annual taxes, the gross income minus the annual taxes, the annual insurance, the HOA fee, the annual management fee, and then the annual maintenance, leasing, and vacancy. These numbers here are actually based on the management and leasing is based on a 2-year, not 1 year, because people don't move every year. They can, but they don't usually. Usually our usual stay is 3 years. So I do a 2-year annualized, and that's where we get the fee here. And then you're looking at a net income of over $1,000. I mean, if it was free and clear, it'd be over $1,000 a month. And then 5.79 cap rate is unheard of in new construction. So here's your numbers at 575, 153 loan amount, 1327, rents around 1850, going to run around $309. Wintertime, the rents maybe $100 less than that. Summertime, they can be $100 higher than that. So you want to get everything on the summer cycle, and we help coach you with that, and your property manager knows. We try to get the leases to renew sometime in between May and August. So back to the days of cash flow, which has been hard to find anywhere. Okay, and then we have investment summary, kind of showing you the numbers, how we come up with our investment of the equity. So this is taking the cost $70,000 to get into it. And we're also coming in with appreciated value, because these homes that we're buying at 218, we were selling, and we were still very happy. People were buying at 242, but you had an instant bump in equity by those appraisals are coming in higher. And then as the value goes up at 5%, we're just using a 5% appreciation, and then your loan balance goes down over time. Of course, slow at first and more accelerates as you go through the loan. But every year, within year 3, you've had 100% return on your initial investment. So that's really, really hard to find in any kind of investment type of situation. So, and over time, you get out to 10 years, you're looking at 312% return. And you still have the asset, and the tenant's been paying the mortgage the whole time. So, but real estate's great. So it's a perfect opportunity for those seeking to diversify their estate. Maybe diversify out of different states, to maybe diversify out of the stock market, to take some of the chips off the table, and also to buy hard assets rather than paper. And we're also, most of what we do is long-term equity growth. This is not buy and fix and flip or BRRR. That's not our game. Our game is very, professionals that want to build a portfolio of real estate and don't want a whole lot of hassles and consistent growth. And then those seeking income tax shelters, we can do a whole seminar on the tax shelter benefits, but definitely using the 2 out of last 5-year rule. If you're selling a primary residence is great. Doing 1031 tax deferred exchanges, another way to defer. And the bottom line is that if when you pass, depending on your tax bracket and your income, when you pass this to your estate, goes to your kids, that you have a stepped up basis, which means that the taxes that were owed or that would have been owed if you sold it the day before you died, you would have paid a huge amount of capital gains and equity depreciation recapture. And a lot of these people have owned homes for a long, long time. You're looking at maybe at 50% of their tax hit. So that all goes away when you bequeath it to your children or to your wherever you're going to, who your beneficiaries are. And then, of course, 1031 exchange is one of our niches, because this is great. There's strategies, and we have it in my other presentations about how we took one house in the Bay Area at 1,300 square to 1,100 square foot and turned it into to 9 houses in Central Texas. When the rental income went from $3,800 a month for the Bay Area house to $13,500, now $17,000 per month, changed our client's life. And he did it tax deferred, didn't have to pay a dime on taxes on his way out. All right, so what to do? This is connect with me. If you're getting this webinar, you may have already worked with me in the past, but if you haven't, love to connect with you. Share this with your friends. You can text me. That's the best way to get a hold of me, is my phone number, 512-423-5626. I sent out, I sent a lot of education, a lot of resources, a lot of virtual tours, a lot of video tours of these properties. We're very passionate about what we're doing. You can make an appointment with me at your convenience rather than play any kind of phone or text tag. And you can do that with callkenn.com, and whatever time you want that's on my calendar, you just plug yourself in, and I'll give you a call, or we can do a Zoom. So we'll discuss the strategies and the properties, and all the kind of stuff, kind of review what we're talking about here, and find out what your goals are and your dreams and how we might be able to help you get there. I'll introduce you to the builders reps to help you find the best property. So we work together directly with the builders and the builders reps to make sure we're getting the right property in the right section of the neighborhood, in the right neighborhood. We help you apply for the builder with the loan so that you can get the NFC forward commitment money, and then you would wire a down payment to the builder, and that down payment ranges anywhere from $1,000 to $1,000 to up to 10% of the asking price of the property. So what not to do, and I kind of talked about this earlier in the presentation, is don't call the 800 number on the website, the builder's website. You'll get a random agent who may or may not know what they're doing, and then you may not get the opportunity to work with me. It doesn't cost you anything to work with me. I give you my 40 years of experience, all my mentorship, all my networks of help, and that's all part of it. The builder pays me. So, and since I can sell anywhere, they're happy to see me come in. I may sell 10, 12, 20 houses in a neighborhood over the course of a couple of years, whereas you may only buy one in a lifetime. So they have a vested interest in working with me because I keep bringing them more. But if you call it on you won't really get a very experienced or good answers, nor will you get the shadow and inventory that I'm able to come up with. So, and also it's saying, don't figure this out on your own. We have these systems; they're all proven. We have networks of help, and we have builders and property managers that this works. It's been working. It does work. It's not rocket science, but it's very much a niche. You don't want to just call any Redfin agent and start to try to buy a house where they don't know anything about, or most realtors don't even own their own investment properties. Many of them don't own their own houses. So, work with somebody who's been in the business for a long, long time that specializes in this. And once again, my services don't cost you anything. It's all paid for by the builder. So there's my contact information. You got my phone number. Me out of the way, 512-423-5626. You can use this link tree to get my resources. You can use the QR code, and then I'm continually updating the resource page here on Kenn's resources on the link tree here. But this presentation will now be at the top of this link tree, but also you can see the podcast that I do, and also the PBS show. My YouTube channel, which is huge, and then a place where you can make an appointment with me. Okay, so thank you for your time. Appreciate you taking your time to watch this webinar. I'd love to connect with you and see what I can do to help you build a portfolio of properties to help you with financial freedom, as well as creating a legacy for your children and your grandchildren. So give me a call when you get a chance. Connect with me. Also email Kenn, Kenn, at buyaustin.com. Phone number is 512-423-5626. Call or text me. And I'd love to help you. Love to see you get started. And if you're in the area, or you want to come to the area, we'll take you on a tour, and we'll show you all the cool things that the Central Texas region has to offer. So appreciate your time once again, and reach out to me so we can get started.